Dear students, warm greetings on behalf of Dr. B.R. Ambedkar Open University. So today's topic is Introduction to Financial Statements. So dear students, in today's tele lesson, we will talk about introduction, meaning of financial statements. Then we will discuss the definition of financial statements, and we'll understand what are the nature of financial statements. Then we will discuss the objectives of financial statements and the different elements of the financial statements. Then we will learn the different types of financial statement and all the users, whoever uses our financial statements. Then we conclude the tele lessons with understanding the limitations of the financial statement. So these are the topics we will cover in today's tele lesson, my dear students. So dear students, let us try to understand what a financial statement is. So financial statements are the end products of accounting process. As we know, my dear students, accounting is all about recording, classifying and summarizing. So it reveals the financial results. So at the end of the day, the financial statement, after recording, classifying and summarizing, it reveals the financial result of a specific period and financial position as on a particular date. In simple terms, my dear students, we will know the financial performance for a specific period of time by preparing a balance sheet, and we will know by preparing a profit and loss account, and we will know what is the financial position as on a particular date by preparing a balance sheet. That is financial performance by preparing a profit and loss account, dear students, and financial position by preparing a balance sheet. So financial statements are prepared and published by corporate undertakings for the benefit of various stakeholders, maybe investors, maybe creditors, maybe shareholders, maybe prospective shareholders, government, tax authorities. So many stakeholders use our financial statements for taking different decisions. So these statements include statement of profit and loss account, we call it as an income statement, and statement of balance sheet, we call it as a position statement. So the basic objective of these financial statements, my dear students, is to provide information required for decision making by the management as well as other outsiders who are interested in the affairs of the business. So my dear students, in simple terms, financial statements are a business's blueprints. So just as architects use blueprints to visualize a building structure, investors rely on financial statements to understand a company's financial health. So these documents, that is the balance sheet and profit and loss account, my dear students, offer a detailed roadmap of a company's past performance, present condition, and also it talks about the future prospects. So in simple terms, my dear students, our financial statements help us to know the company's past, present as well as future prospects. So my dear students, by interpreting the numbers and ratios within these statements, if you see the financial statement, my dear students, the balance sheet or the profit and loss account, it is all about numbers. So by interpreting the numbers and ratios, whatever we have within these statements, investors can make informed decisions about where to allocate their capital. So in simple terms, my dear students, financial statements are reports that summarize a company's financial activities and overall financial conditions. So my dear students, financial statements are reports that summarizes a company's financial activities and overall financial conditions. So these documents are typically prepared regularly. Normally for every 3 months, we call it as interim financial statements, or annually, the annual financial statements, to give investors, lenders or any other person, whoever is interested, a clear picture of the company's financial situation. That is, in simple terms, financial performance for a particular period of time, that is 1 year time, the profit and loss account, financial position, the balance sheet, or on a specific date. So financial statements are the basis for decision making by the management as well as other outsiders who are interested in the affairs of the firm. So those whoever are interested are investors, creditors, customers, suppliers, financial institutions, employees, potential investors or prospective investors who are willing to invest in our company, government and general publics. Though these insiders, that is the employees working and the management, and outsiders like the investors, creditors, customers and suppliers, use our financial statement for different decision making purposes. So now, dear students, let us try to understand the meaning of financial statements. The term financial statement generally refers to two statements. One, the position statement, that is the balance sheet. Two, the income statement or the statement of profit and loss account. So, two main financial statement. One, the position statement or the balance sheet. Two, the income statement or the statement of profit and loss account. Dear students, now let us try to understand the definition of financial statements. So, the financial statements provide a summary of the accounts of a business enterprise, that is the balance sheet, reflecting assets, liabilities and capital. So, balance sheet reflects assets, liabilities and capital as on a certain date, and the income statement showing the results of operation during a certain period of time. This definition is given by John N. Mayer. So, in simple terms, to conclude, my dear students, financial statements are the outcomes of summarizing process of accounting. So, once again, financial statements are the outcomes of summarizing process of accounting. So, my dear students, as per section 2, subsection 40 of the Companies Act 2013, financial statements in relation to a company include the following. This also works out as per Indian Accounting Standard 1. So, as per Ind AS 1 also, and as per section 2, subsection 40 of the Companies Act 2013, financial statements include all these 5. 1, a balance sheet as at the end of the financial year. 2, a statement of profit and loss for the financial year. 3, cash flow statement for the financial year. 4, a statement of changes in equity if applicable. And 5th, the explanatory notes. So, all these 5, 1, a balance sheet. 2, a profit and loss account. 3, a cash flow statement. 4, a statement of changes in equity. 5, the explanatory notes, or the footnotes, what we call. All these 5 are important financial statements which a company prepares annually. Now, let us discuss what a financial statement is and what its main purpose is. So, the main purpose of financial statement is to provide accurate and reliable information about a company's one, financial position, that is what it owns and what it owes. That is, the balance sheet shows what a company owns, that is the assets of the company, and what a company owes to outsiders, that is liabilities at a specific point of time. 2, the financial performance, that is how much money it's making, that is the profit or loss. The income statement reveals how much money the company has made, that is the profit or loss over a period of time. The third one is the cash flow statement, that is how money is moving in and out of the business. So, the cash flow statement tracks how cash moves in and moves out of the business during a particular period of time. So, dear students, there are 3 main purposes for the financial statement. One is financial position, the balance sheet. 2, the financial performance, the profit and loss account or the income statement. 3, the movement of cash flows in and out, that is the cash flow statement. So, this information helps investors assess the company's financial health, profitability and potential for future growth. So, dear students, Investors can get a good sense of a company's overall health and performance by looking at these statements together. For example, when you look at a profit and loss account, company might show huge amount of profits in the income statement or the profit and loss account. But when you check the cash flow statement, when a customer comes to collect money, there is not sufficient fund available. So this tells us that the company is unable to collect money from the customers for the credit sales whatever it has made. So this is a red flag for the company. So the company has to take immediate actions to improve its liquidity position. As we know, my dear students, the financial statements are prepared based on accrual concept. That is, whether you received or not, whatever is the sales for that particular period has to be recorded in the financial statement. That is cash sales as well as credit sales. So if you are unable to get money from the credit sales, whatever you have made, it means you have less of liquidity. So the financial statements helps us to know all such things. So in simple terms, this is what a financial statement is. Now, dear students, let us discuss the nature of financial statements. The chronologically recorded facts about events expressed in monetary terms for a defined period of time are the basis for the preparation of periodical financial statements. So whatever order as per the date you get the events are recorded on that particular basis periodically in a financial statement, which reveals the financial position on a particular date and the financial result of performance during a particular period of time. The American Institute of Certified Public Accountant states the nature of financial statement as, it defines financial statement as the statements prepared for the purpose of presenting a periodical review of report on progress by the management and deal with the status of investment in the business and the results achieved during the period under review. They reflect a combination of recorded facts, accounting principles, and personal judgments. So in simple terms, my dear students, as per the definition, whatever we have learnt, the nature of financial statements can be divided into four. 1. Recorded facts. 2. Accounting conventions. 3. Postulates. 4. Personal judgment. Now let us discuss all these 4 points in detail. The first point is recorded facts. So financial statements are prepared on the basis of facts in the form of cost data recorded in accounting books. That is, the historical cost is the basis of recording transactions. For example, my dear students, I buy a machinery today for 1 lakh rupees. So the machinery is recorded in the books of accounts for rupees 1 lakh. This 1 lakh is the historical cost of the machinery. After 5 years, the value of machinery may be 10 lakhs, but the amount what is shown in the balance sheet is only 5 lakhs. That is the historical cost, the cost at which I bought that particular asset. You do not change the value of the asset in the balance sheet as per the market value, what is prevailing in the market right now. So the historical cost, my dear students, is the basis of recording the transactions. So the figures of various accounts, such as it may be cash in hand, cash at bank, bills receivable, fixed assets, etc., are taken as per the figures recorded in the accounting books, that is as per the historical cost data. The assets purchased at different times and at different prices are put together and shown at cost. So as these are not based on market prices, dear students, the financial statements do not show current financial condition of the concern. So second important nature, my dear students, are the postulates. The financial statements are prepared on certain basic assumptions known as postulates, such as going concern postulate, money measurement postulate, realization postulate, etc. So the going concern postulate assumes that the enterprise is treated as a going concern and exist for a longer period of time. Like, you do not start a business assuming that you will close it after 5 years or 10 years. So you assume that it will go for a longer period of time. So the assets are shown on the historical cost basis. The second postulate, the money measurement postulate, assumes that the value of money will remain the same in different periods. Though there's a drastic change in the purchasing power of money, like the example just now we have taken. You bought a machinery today, this year, for 5 lakh rupees. After 5 years, the value of machinery increases to 10 lakhs. But still the value of machinery is shown as 5 lakhs. You do not consider the rise in price. You do not consider purchasing power of money, increase in prices, inflation, etc. while recording the value of asset in your books of accounts. The assets purchased at different times will be shown at the amount paid for them, that is the historical cost. So dear students, different postulates like the going concern postulate, money measurement postulate, realization postulate, etc. are followed while preparing the financial statement. Lastly, my dear students, personal judgment. Under more than one circumstances, facts and figures presented through financial statements are based on personal opinion, estimates and judgments. Like, for example, dear students, while calculating depreciation, 5% as 10%, while calculating the economic life of a fixed asset, 5 years, 10 years, you use your personal judgment to decide 2%, 3%, 4%, 5 years, 10 years, 15 years. Or when you're calculating provision for doubtful debts, you make an estimate on personal judgment. While you're valuing inventory based on cost or net realizable value, whichever is less, you use your personal judgment to decide what will be the cost or what will be the net realizable value. So dear students, personal opinion, judgments and estimates are made while preparing the financial statements to avoid any possibility of overstatement of assets and liabilities, income and expenditures, keeping in mind the convention of conservatism. The convention of conservatism tells us anticipate all losses, not gains. So you anticipate all losses, but you do not anticipate any gains. So thus, my dear students, to conclude, financial statements are the summarized reports of recorded facts and are prepared following accounting concepts, conventions, accounting policies and accounting standards, and you also take into consideration the different requirements of laws prevailing in the country in which you prepare your financial statements. Dear students, after understanding the nature of financial statements, now let us understand the objectives of financial statement. So financial statements are the basic sources of information, as we have been learning, dear students, to the shareholders it may be, and other external parties like the investors, vendors, suppliers, customers, etc. for understanding the profitability and the financial position of any business concern, that is the financial performance and the financial position. So they provide information about the results of the business concern during a specified period of time in terms of assets and liabilities, which provides the basis for taking decisions. Thus, dear students, the primary objective of financial statements is to assist all the users in taking the decisions. So now let us discuss the objectives of financial statements, dear students. The first objective is to provide reliable financial information about economic resources and obligations of a business firm to investors and other external parties like shareholders, customers, government, trade unions, employees who have limited authority, ability or resources to obtain information. The second objective, dear students, is to provide information about the earning capacity of the business. The first one was to provide reliable financial information. The second one is to provide information about the earning capacity of the business, which can gainfully be utilized to predict, compare and evaluate the business firm's earnings capacity. The third objective, my dear students, is to provide information about cash flows to investors and creditors for predicting, comparing and evaluating potential cash flows in terms of amount, timing and related uncertainties. One to provide reliable financial information, that is financial position. Second, to provide information about the earning capacity of the business, that is the financial performance. The third one is to provide information about the cash flows, the movement of the cash. The fourth one is for judging management's ability to utilize the resources of the business effectively. So these are the four important objectives of financial statements, dear students. Now let us see what are the different elements of financial statements. So financial statements can be broadly classified into two. One is the balance sheet, two the profit and loss account. The balance sheet can be broadly divided into three aspects or elements. One is assets, two liabilities, three equity. The profit and loss account can be divided into expenses and losses, revenues and incomes. I repeat, my dear students, financial statements divide into two elements, balance sheet and profit and loss account. Balance sheet is divided into three main elements, assets, liability and equity. Profit and loss account is divided into two elements, dear students, expenses and losses, revenues and incomes. As you know, my dear students, whenever you prepare a profit and loss account, your teacher might have told you a profit and loss account is a nominal account. So you debit all expenses and losses, you credit all incomes and gains. So profit and loss account is divided into two main elements. Dear students, now let us discuss the different types of financial statement. One, as I have been telling you, there are only two main types of financial statement. One, the position statement or the balance sheet. Two, the income statement or the profit and loss account. However, my dear students, as per generally accepted accounting principle, it specifies, and also the Indian Accounting Standard 1 specifies that a complete set of financial statements must include 1. A balance sheet, 2. An income statement, 3. A statement of changes in owner's equity, 4. A statement of changes in financial position. This statement of changes in financial position, my dear students, can be divided into two, the funds flow statement and the cash flow statement. And also, dear students, every company which is registered under the Companies Act 2013 shall prepare its balance sheet, statement of profit and loss account and notes to accounts thereto in accordance with the manner prescribed in the revised Schedule 3 of the Companies Act 2013 to harmonize the disclosure requirements with the accounting standards and to converge with the new reforms. So, dear students, now let us try to understand the different elements of the financial statement. The first element, the balance sheet. It is also known as a statement of financial position. So, balance sheet presents the financial status of a company by showing its assets, liabilities and equity at a particular point of time. The net worth of a business, dear students, is calculating by subtracting liabilities from assets. When you subtract liabilities from assets, the difference what you get is called as net worth. So, dear students, in simple terms, the balance sheet provides a snapshot of a company's financial position at a specified point of time. So, the balance sheet shows asset, what the company owns, cash, inventory, equipment; liability, what the company owes, loans, accounts payable, etc. Shareholders' equity, the difference between assets and liability, essentially the company's net worth. This is the formula, my dear students, for calculating assets. The following formula summarizes what a balance sheet shows, that is, assets is equal to liabilities plus shareholders' equity. That is, a company's assets have to be equal to or balance the sum of its liabilities and shareholders' equity. So, dear students, a balance sheet is a financial statement of an organization that shows its financial position, liabilities, assets and equity on a particular date. It means that balance sheet does not show the figures of an organization for an accounting period, but it shows for a specific date. On a particular date, balance sheet on a specific date. It is not for a particular period. And dear student, there are two sides to the balance sheet, namely the asset side on the right hand side, the liability side on the left hand side. The asset side of the balance sheet shows the debit balances of the organization. However, the liability side of the balance sheet shows the credit balances. And dear students, the total of asset side must always be equal to the total of the liability side. We should always try to tally the balance sheet. Both the sides should be equal. Now, dear students, let us try to understand what are assets. Assets are things that a company owns that has some value. This means they can either be sold or it can be used by a company to make products or provide services that can be sold. So assets include physical properties, which you call it as tangible, like plant, machinery, equipment, etc. It also includes intangible assets. Assets also can be classified into current assets, which can be converted into cash within one accounting period. Example, cash, bills receivable, bill inventory, etc. Non-current assets, which are not expected to be fully utilized within the current accounting period and which spans across multiple periods, which includes tangible assets like property, plant and equipment, and intangible assets like patents and trademarks. Liabilities are amounts of money that a company owes to others. This can include all kinds of obligations like money borrowed from a bank, rent for use of a building, money owed to suppliers for materials, salary a company owes to its employees, or taxes owed to the government. Liabilities also includes obligations to provide goods or services to customers in future. So liabilities are financial obligations that company owes to external parties. They can be current, that is short term, or non-current, long term. Current liabilities are those due within 1 year. Example, accounts payable, short-term loans and accrued expenses. Non-current liabilities or obligations due in more than 1 year, like long-term loans, lease obligations and deferred tax liabilities. Equity. Shareholders' equity, sometimes called capital or net worth. It's the money that would be left if a company sold all its assets and paid off all its liability. This leftover money belongs to the shareholder or the owners of the company. So, dear students, as income statement is also called as a profit and loss account, it has three main elements: the revenue, the income generated from sale; expenses, the cost of a company which it incurs on a daily basis like salary, rent, depreciation; and the difference between expenses and income, the profit and loss account. The third one, statement of changes in equity. It shows the difference. This statement shows how a company's equity changes over the period of time, the difference, how it changes. It includes beginning equity balance, net income or loss for the period, dividends paid to the shareholders, other changes in equity like issuing new shares. So finally, the statement of changes in financial position, my dear students, it includes the funds flow statement and the cash flow statement. A funds flow statement is generated to determine a company's periodic increase or decrease in working capital, and a cash flow statement is a financial statement that shows how the cash position has changed over time by identifying the main sources and uses of cash. The cash flow statement is divided into three main activities: the operating activities, the investing activities, and the financing activities. Operating activities are cash generated from day-to-day business operations. Investing activities are cash used for long-term investment, and financing activities cash from investors or lenders and payment of shareholders. So, dear students, to conclude with, financial statements plays a crucial role in the financial management and decision-making process of businesses, whether it's assessing profitability, liquidity, solvency, or overall financial performance. These statements offer valuable insights into a company's operations. By analyzing the income statement, balance sheet, cash flow statements, and statement of changes in equity, stakeholders can gain a comprehensive understanding of a company's financial health and make informed decisions. It's essential for investors, creditors, and management to be proficient in interpreting these statements accurately to mitigate risk and capitalize on opportunities effectively. So, dear students, thank you for your patient listening.